Hi everyone, hope you all must be doing great. So today we are starting with a very quick revision of our one of the most important chapter, PGBP. So this we will be doing it from our beautifully crafted chart book, which is easily available on our website. You can go and download the PDF. If you would like to print it, I would highly recommend that you can get the printout also. In case you will not be able to get it printed, at least save this into your device, in your mobile phone, laptop or computer, right? So this chart book, it's approximately income tax I have covered in 34 pages. All the amendments for our May 2024 examinations are duly covered in this chart book, right? And you will find this chart book as a very useful and important tool for your income tax preparation. All the things are very beautifully covered, thoroughly covered, right? Okay, so let's start with our PGBP revision. First of all, here section-wise summary is also given that what particular section is applicable in which particular scenario. But yes, there would be some sections which are only related to CMA and CS students. So for CA Intermediate, you can skip those sections. Let's start with first section, section 28. Section 28 is a charging section for PGBP. It says charging section of PGBP means that it contains some certain types of income which would be taxable under this particular head. So we understand the first point says that if you have any profits or gains from any type of business or profession which the assessee is carrying at any time during the previous year, even if that person is carrying for not for the entire year, but for let's say for 1 month or 2 months also, then also that income is going to be covered under PGBP. Second point says that if you have received, if you are carrying your business and profession in the course of your business and profession, you receive any gifts or perquisites or other facilities from your clients, from your customers, from your suppliers in the course of business and profession, that gift, that perquisite, that facility would be covered under PGBP. And if you remember that we understand that gift is also taxable under salary if they are provided from the employer, right? And gifts are also covered under IFOS if the person is not your employer, not in the course of business and profession. Let's say if you receive gifts from your friends or any other person, then in that case it would be taxable under IFOS. So we understand gifts are covered under three chapters, but here it is important that these gifts are received during the course of your business or profession. Third is non-competing fees. So if you receive any non-competing fees, then also PGBP income. Some received under key man insurance policy. This key man insurance is very important. You understand what is key man insurance policy is. So if a business has received this amount, the person who is carrying business or profession, if that person receives this amount, that becomes their PGBP income. And again, we have done key man insurance in salary chapter also, in IFOS also. In salary chapter, if the employee receives this amount, then it becomes salary income. If other person receives this amount, it becomes IFOS income. But if the person who is carrying business or profession, if that person receives this amount, it becomes PGBP income. Correct? Okay. Next is whenever you convert your stock into capital asset, it becomes your PGBP, right? Covered in section 28. Vice versa, if you convert your capital asset into stock in trade, that we see in capital gain, right? So you have to see that what are you converting. If you are converting stock, see, stock you sell, that is your PGBP income. So if you are converting your stock into capital asset, PGBP. Capital asset into stock, capital gain, right? So let us understand this particular point, inventory converted into capital asset. So whenever you will convert your stock into capital asset, so at the time of conversion itself, we are going to tax you. We'll make it PGBP income. So whatever is the fair market value of that stock on the date of conversion, that would be your PGBP, right? In capital gain, what we used to do is there is a little difference. First of all, we are converting capital asset into stock in trade. And whenever this conversion happen in that year, we don't tax you. We defer that in capital gain. We defer that unless and until that stock is actually sold, right? But in PGBP, whenever you are converting stock into capital asset. So as soon as you will convert, the fair market value of that stock will going to make it PGBP income. Next is whenever the partners receive any kind of remuneration. It could be in the form of interest. It could be in the form of salary, bonus, commission, any remuneration which partners receives from their partnership firm, it becomes their PGBP income. Whose PGBP income? Partners PGBP income. So whenever partners will be furnishing their ROI, they will show this as their PGBP income. And detail we will also see in section 40 small b, that is specifically related to partnership firm. Okay. Export assistance. So if you receive any cash amount related to your export incentives by government or from any other person, it could be in the form of if the person is selling their import entitlement license or any type of duty drawback. So these are export incentives. So if you receive any export incentives, please make it PGBP. Compensation on breach of business contract. So if there is any terms and conditions of a business contract which are getting terminated or it is getting modified, in that case, if the person receives compensation due to the breach of business contract, that again would be PGBP income. And whenever you sell your 35AD assets, 35AD is those specified business. I'll be discussing 35AD also. So whenever you sell your 35AD assets, so the income which you receive on that asset, that is again PGBP income. So these are few important points which are covered under section 28. Section 29 is computation of PGBP. How you will be going to compute this PGBP income. So this is very easy. First of all, the profit as per your P&L account. So the net profit which has been given to you in your question. So that should be the starting point. So always start from the net profit as per P&L account. So start with the net profit. So whatever first step is start with net profit. Second step is whatever are the expenses which are debited in P&L account. Whatever the expenses which are debited, you have to see whether these expenses are allowed under section 30 to 37. If yes, then it's okay. We're going to allow it. But if it is not allowed under any of these sections which are from 30 to 37, then we are going to disallow that. So what we will do in that case, we will add it back. We will add it back. So whatever expenses which are debited but not allowed, please add them. Okay. The third step is you have to see the income side. You have to see the income side. If there is any income which is covered under section 28, business income, or even under section 41, remember, deemed business income. So if there is any income which is related to section 28 or 41, we are fine with it because that is PGBP. But if there is any income which belongs to some other head, let's say it's house property income, capital gain income, IFRS income, other head income. So you have to subtract that. Or in that case, if it is exempt income, so if in your P&L account, in your credit side, you see that there is any income which is not covered under PGBP, it is covered under any other head, or in case it is exempt, then please subtract it from here because that is not your PGBP. So you have to deduct that income, right? After that, so first step was net profit, second step was expenses side, third step was income side, right? Then comes your information. So in your information, if anything is mentioned, let's say for any type of income which is mentioned, that it should form part of your PGBP, but it is not been credited to the P&L account by the assessee. So in his P&L account, this person has not taken that income into consideration, but in information, you find that there is any income which should be your PGBP income. So make it PGBP income. So you have to add it. Similarly, if you find that there is any expense which should be allowed under any of the section from section 30 to 37, it should be allowed, but the assessee has not debited that expense, so you can allow that expense also, right? So this is how you compute your PGBP income. This is section 29, computation of PGBP. Got it? Now main sections. I'll be discussing section 30 to 37 now. What are these expenses? These sections are related to expenses which are allowed while computing your PGBP income, right? These are the expenses which are allowed. Got it? First is section 30. Section 30 is related to the expenses related to the building which you used in your business or profession. So if you use any type of building in your business and profession, so the expenses related to that building, it could be rent of the building, it could be insurance premium paid for the building, it could be repairs for the building, it should be revenue in nature, right? That repair should not be of capital in nature. So, or even if you are paying any municipal taxes of that building, so those expenses are allowed under section 30. But please remember some few points regarding section 30. If it is notional rent, it is not actual rent. Let's say the assessee is the owner of that particular building, and if he says that this is the opportunity cost, this is the rent which actually I'm not paying, but I would have paid this particular rent, so that is called notional rent. Notional rent is not allowed. Actual rent should be allowed, right? And second important thing, please remember, we have section 43B. That is a very important section. I'll be discussing that section also. It contains certain expenses. Those expenses are only and only allowed if they are actually paid by the assessee. Till what date it should be paid? It should be paid either during the previous year or up to the due date of ROI. You should pay those particular expenses up to the due date of ROI, irrespective of the method of accounting which the assessee is following. Those expenses should be paid up to the due date of ROI. then only they will be allowed. Otherwise, if they are not paid up to the due date of ROI, they will not be allowed in this year. So whenever they will be paid after that, it will be allowed in those previous years. So 43B, we will also discuss. That is one of the important section. And yes, there is a little amendment also in 43B regarding MSME that I'll be discussing. Okay, so one of the expenses, rates and taxes. So let's say if you are paying any taxes related to the building, so it should be allowed, but if it is mentioned that it is not yet paid up to the due date of RI, please don't allow it, right? Because on rates and taxes, section 43B would be applicable. I hope that you are able to recall this particular provision also. Then we have section 31. 31 is related to plant and machinery and furniture. Again, plant and machinery and furniture. So if the assessee has incurred any repairs and insurance, only repairs and insurance is covered under section 31. So let's say for plant and machinery, the assessee has paid rent, whether that expense is allowed, but that would be not be covered under 31, because 31 only covers repairs and insurance. That to revenue type of repair. Capital repairs are not any repair which is related to, which is in the nature of capital expenditure, that will not be covered, only revenue nature. But I was saying that if you have paid rent of machinery or furniture, 31 will not cover, but yes, it will be allowed under section 37. So anyways, it will be covered. If you don't remember the section, it's okay. But yes, rent of plant and machinery is covered under section 37, right? Because this section only takes care about repairs and insurance. Got it? And yes, if there is any type of expense, which is, let's say if you have paid any repair payment for your machine, but that machine is used for partly for business purpose, partly for personal purpose. So the only proportionate expense which is related to your business purpose, that you'll be going to allow. It is for all the sections. So we have a specific section also, section 38, which says about proportionate deduction. It will say that whatever the expenses which you are incurring, if it is for partly for business purpose or profession purpose and partly for some other thing, then for some other thing we are not going to allow. Only the expenses which are related to your PGBP, that business and profession, that only we are going to allow, right? So this is section 31. Section 32, a very beautiful section, depreciation. Section 32 says, first of all, which method we should follow? WDV method. So generally we follow WDV method. So whenever we follow WDV method, we charge depreciation block wise. You understand what are blocks, right? Same categories of asset with same rate of depreciation are the blocks, right? So can any other method be followed? The answer is yes, only and only for power generating units. So power generating units have an option. By default, they will be following straight line method. If they want, then they can also follow the WDV method also, right? And this option they have to exercise in the very first year while filing their first return, with the year in which they have commenced the business. In that year itself, when they will be filing the return of that year, at that particular point of time, they have to choose. By default, they will be getting straight line method. But if they would like to choose the WDV method on block, then they can choose that method. But once they choose that particular method, it will be continued for the entire life, right? Okay. First of all, understand WDV method. You understand if you are following WDV method, for all other assessee, we will follow WDV method, and it should be on block of assets, not on individual asset. Second important thing is that we charge depreciation block wise. Either we will charge full depreciation, or we will charge half depreciation, or we will not be charging any depreciation, right? So let's say if you have purchased any asset, but you have not even put to use even for a single day, it is thus asset is never put to use, then you will not be charging depreciation in that year. Although it will be form part of the block. Let's say assessee during the previous year 23-24, let's say assessee has purchased the asset. So whenever that assessee has acquired the asset, it will form part of the block. But you will see whether this asset is put to use or not. If it is not put to use, if it is mentioned in the question that it is not put to use during the year, then you will not charge depreciation. Yes, but please remember one more point over here also, because sometimes the asset is passively used. What is passively used? For example, the assessee has purchased standby machines, or let's say fire extinguisher that person has purchased. So we purchase fire extinguisher, we will keep it, and we will only use it if there in case of fire. Let's say there is no fire occurred during the year, but that fire extinguisher we have actually we are using it passively. So in that case, if it's a case of passive use, then you will be giving the depreciation, right? Second important thing is that when you will be charging half depreciation, for half depreciation, two conditions must be satisfied. Two conditions must be satisfied over here. First condition is the asset must be acquired in that previous year and should be used in that previous year only for less than 180 days. If both these conditions are satisfied, acquired during the previous year, used for less than 180 days, if both the conditions simultaneously are satisfied, then only you will be charging half depreciation, right? Okay. And how you charge depreciation, you know the format. So first of all, for any block, you start with the opening value, that is WDV at the beginning of the year. Whatever any asset which are acquired during the year which falls in that block, please add them. If you have sold any asset or you have discarded any asset, so whatever the money received by you, you have to subtract it, right? So this is the depreciation value at the end of the year on which you will be charging depreciation, right? Also remember, if this value comes to nil, then you will not be going to charge depreciation. Although it might be case that physical assets exist, but this WDV at the end for charging depreciation comes to nil or negative. In that case, please do not charge depreciation. Right? So no depreciation in the following cases if the WDV is nil or negative, or even if the asset is not put to use, you will not charge depreciation. If the entire block is sold, if you have sold the entire block, in that case, there would be short-term capital gain or short-term capital loss as per section 50 that we'll do in capital gain revision. That although we have done the capital gain revision in detail also, if you'll suggest, if you can just comment me over here, if you want revision this fast, rapid revision for other chapters also, you can just give that suggestion to me in the comment section. Okay. So for entire block, we understand if the entire block is sold, in that case, we cannot charge depreciation. Why? Because we charge depreciation on block of assets. If the entire block is sold, right? In that case, please do not charge depreciation. In that case, there would be capital gain, either loss or gain, whatever the case may be. Okay. Other important point is additional depreciation. First of all, please remember that additional depreciation is given to only those assessee who are following optional tax regime. If the assessee is following default tax regime, then please do not give additional depreciation. First of all, please remember this. In default tax regime, no additional depreciation would be given. If the assessee is following optional tax regime, old tax regime, then only additional depreciation provision is there. So how much is the additional depreciation? First of all, it is applicable only for assessee who are into manufacturing business. So if the assessee is into manufacturing business. Second point is that it is available only on plant and machinery, not on building, not on furniture, not on any other thing, only on plant and machinery. Third thing, it should be used in the factory, in the production process. It should be used in the factory, then you will be charging additional depreciation, but it should not be vehicles or ships or airlines or aircraft. On that, we don't charge depreciation, additional depreciation, right? We only charge normal depreciation in that case. But if these conditions are satisfied, then you will be charging additional depreciation. How much? 20% of the actual cost. Whatever is the actual cost of that machine, that should be new machine. It should not be second-hand machine. So whatever is the actual cost of that machine, you can claim 20% additional depreciation. But yes, if that new asset, new plant machinery is used during the year for less than 180 days, then claim 10% of additional depreciation this year and remaining 10% in the next year. But please remember, it is only under optional tax regime. Okay. Power generating units, I have already discussed that they will be getting, by default, they will be getting SLM method. And SLM rates, you don't have to remember. It is not even given in your study material. Whenever, although examiner will not ask the question that please calculate depreciation as per SLM method, they don't ask such type of question. But in case if there is a question, they will also give you the rate of depreciation also. They will give you the rate of SLM method. Those rates which we remember, so on building 5%, 10%, 40%, those rates are for WDV method, not for SLM method. Got it? Okay. But one thing you should remember, that whenever this power generating, if this is a power generating assessee, and they are following SLM method, and whenever they will sell that particular asset, in that case, what should be the tax treatment? So what you should, I've already discussed this in our detailed revision also, but please let me revise this once again. So whenever this power generating unit is selling their asset, who are charging depreciation on SLM basis, then you know that you have to draw this number line. First determine whatever is the original cost of that particular machine. Let's say this is the power generating unit and they have purchased a machine for rupees, let's say 40 lakh. 40 lakh they have purchased the machine, and right now they were charging SLM basis on individual assets, and right now the WDV is 30 lakh. The WDV is 30 lakh, right? So I can plot that original cost is 40 and WDV is 30 lakh in this case as of now. So let's say they sell this asset. They are selling this asset If they sell this that asset of less than 30 lakh, that would be the loss area. That will be giving whatever is the loss, we call this as terminal depreciation under section 32. So we'll be giving that particular expense, we'll be treating that particular expense in that very year. Whatever is the loss, we'll call it terminal depreciation under section 32. We'll give the deduction. But if you sell that asset for more than WDV, in this case more than 30 lakh, so it will be your income area. This green portion would be your income area. In fact, this also is your income area. But yes, if you sell this asset of above 30 lakh but up to 40 lakh, so up to this amount would be your PGBP income. It is called balancing charge and it is taxable under section 41, that is deemed business income. But in case if you sell this asset for more than 40 lakh, so let's say if you sell this asset for 44 lakh, so in this case up to this amount 10 lakh would be your PGBP, and this 4 lakh 44 minus 40 would be your capital gain. But again, it depends on capital gain. See, if it is long term, if it is more than 3 years, then you will how you will computing capital gain? 44 minus indexation of 40, right? But if it is short term, then you can simply subtract 40. 44 minus 40, 4 lakh would be the short term. But if it is long term, then indexation will also be applicable. Correct? So this was important. Okay. These section 33AB, 35AB and all, these are not for CA Inter. I have already mentioned this is only for CMA students and CA students. Okay, now come to section 35, scientific research, an important section. There are two types of scientific research expenses. One is in-house research that should be related to your business. One is in-house research. Second is outside research. Here, this is actually the contribution. It is actually the donation which you are giving to IIT, National Laboratory or any approved university or institution. First of all, please remember in-house research is available for both types of assessee, whether the assessee is following default tax regime or optional tax regime, it is available for both. But outside research is available only for optional tax regime. If the assessee is following default tax regime, in that case, this outside research would not be available. In-house research would be available, but outside research would not be available for default tax regime. It is only for optional tax regime. Okay. Now understand how much deduction we'll be getting under section 35. So first of all, if it is in-house research, then whatever is the revenue expenses we are incurring or the capital expenses we are incurring, will be getting 100% deduction. And you understand, on land, if we are incurring any capital expenditure on land, there is no deduction in the entire income tax. So other than land, you can get the deduction, right? And if these expenses are related to before commencement, this is in-house research and these expenses are incurred before the commencement of business, then you can allow that particular expenses also. But please remember that you cannot go beyond 3 years. So you can take last 3 year expenses before the commencement of business, but not before that. So last 3 year you should remember. And capital, if it is a capital expenditure except land, 100% deduction is allowed. If it is a revenue expenses which is related to before commencement, then only two types of expenses are allowed. One is salary and other is raw material expenses. If it is after commencement revenue expenses, all revenue expenses are allowed. But if it is before commencement of business, then only revenue expenses, salary and raw material is allowed. Capital all allowed except land, right? So please remember last 3 years. And related to revenue, there is a change. After commencement, no problem. Before commencement, only salary and raw material, right? Outside research. Outside research, as I've already discussed, it is only available for the assessee who are opting for optional tax regime. So outside research, whatever is the contribution which you have made to any approved institution, like approved university, approved companies, approved association or institution, approved universities, national laboratory, IITs, so you can give a contribution over there. 100% deduction would be allowed in that case, right? And also remember, if at the time when you have given this contribution, deduction would be allowed, but afterwards, let's say that particular organization, that particular institution, their approval is withdrawn by the government, in that case also it is irrelevant, because the only point you should know is that whenever you are giving this particular contribution, this donation, that institution should be approved, right? So this is 100% deduction is allowed. Next is sale of scientific research asset. So it depends, when are you selling this asset. So are you selling this asset directly? First you are using it for scientific research purpose and then now you are directly selling it, or it depends whether you have first taken it into your normal business, then you are selling it. So first of all, let's understand the first portion. Let's say you are selling it directly. First you have used for scientific research and now you are selling it. You have not brought it into your normal business. So in that case, the same type of concept, the same number line. So let's say there was a scientific research asset which you have used for in-house research. Let's say it was for 50 lakh. Original cost was 50 lakh. How much is the WDV? Obviously zero. Why zero? Because 100% deduction is available. So right now the WDV is zero. So whenever you will be selling this asset, so obviously it would be more than zero, right? So it would be a profit area. So whenever you will be selling this asset up to 50 lakh, you understand that would be PGBP income under section 41. And if it is more than 50 lakh, it will be the capital gain. If it is long term, then you can index that 50 lakh. If it is short term, you can subtract 50 lakh. So let's say if you are selling it for 56 lakh, if it is short term, 56 minus 50. If it is long term, 56 minus indexation of this 50 lakh is available, right? So this would be applicable if you are selling this asset directly without using a normal business. But let's say first you convert that asset, first you bring that asset into your normal business. So first of all, it will be added in your block of asset, whatever is the respective block, whatever this asset belongs to that particular block, it will be added in that block at what value? Nil value. Please remember, whenever a scientific research asset on which 100% deduction is claimed, obviously if you have taken a 100% deduction, you have taken the entire benefit. So you cannot claim the depreciation on that value. So it will be although added in that block, but at what value? Nil value, at zero value it will be added, right? And you'll be charging depreciation on the block, right? Okay. And second thing, whenever you will sell that asset, once you have brought it into your normal business, it will form part of your block. So whenever you will sell that asset, it will be sold, it will be treated in the same manner as if the part of the block is getting sold, right? Okay. This was section 35. Another important section, 35AD, it is related to specified business. Specified business. 14 types of businesses are specified business. And the point here is, if the assessee is into such type of business and they have incurred any capital expenditure, they can claim 100% deduction on their capital expenditure. Three types of assets will not be allowed covered over here. One is land. Obviously, land is never covered in any of the deduction. Land, goodwill, and financial instruments. So, except these assets, if the assessee is into these kinds of businesses and they are incurring expenses on related to capital expenditure, they can claim 35AD. It's an optional deduction, right? First of all, understand that 35AD is only available under optional tax regime. If the assessee is following default tax regime, 35AD would not be available. Getting it? Okay. Now understand what are these 14 types of businesses. You already know. Let's revise them once again. So although I have mentioned the date also, that if these businesses are commenced after this, on and after this date, then only they become eligible for 35AD. But yes, I know that this is quite difficult to remember these dates. You can leave the date, but you should know what type of businesses are there. So let me read it out once again for you. Cross-country natural gas pipeline. Second is cold chain facility. Warehousing for agriculture produce. Non-agriculture produce? No, it should be agriculture produce. And only one non-agriculture is there over here. Warehousing for storage of sugar. Sugar must be over here. Okay. So warehousing for agriculture produce. 2-star or above category hotel. Hospital of minimum 100 beds or more. Slum housing redevelopment, affordable housing, fertilizer production, inland container depot, custom freight station, beekeeping business, warehouse for sugar storage, we have already discussed, iron ore slurry pipeline, semiconductor wafer fabrication, and infrastructure facility. Please remember, these are the 14 types of businesses. Here, if the assessee would like to claim 35AD, then 100% deduction is available except those three assets, right? And you also understand, in case there is a loss in these specified business, then the loss from specified business can only be set off from this other specified business only. So these 14 have a small family. They can adjust the loss between themselves only. They cannot claim the loss from other non-specified business. Okay. Some important points, that if you have made payment of more than 10,000 rupees in cash, then that deduction would not be available, you understand. And also important point is that if you are claiming 35AD, if the assessee is claiming 35AD, only the assessee who are opting for optional tax regime, they can claim it. Okay. If you are claiming 35AD, then section 10AA deduction would not be available to you. And also chapter 6A deduction. Which deduction from 80C to 80? Not all. Chapter 6A heading C, that is profit link deduction, which starts from 80IA series till 80 RRB. That deduction would not be available. I believe that you are able to recall this point also. So if assessee is claiming 35AD deduction, then 10AA deduction and 80IA to 80 RRB. Although most of the sections are not there in our intermediate level, we'll do it in our next level. But yes, we understand QQB is there, double J double A is there, RRB is there. So we cannot claim deduction under those sections. Okay, an asset must not be transferred before 8 years. So what if the asset is transferred into normal business before the expiry of 8 years? So whatever the deduction which we have given of 35 AD, will make it income. We will make it income. Whether we'll make it entirely the income in the year whenever this, if it is transferred before 8 years, no, we'll also consider the depreciation which we would have given. So what we'll do, whatever the deduction which you have claimed, we will make it the income, but we will also consider the deemed depreciation of those years. So whatever it would be the deemed depreciation, we will give you that advantage. So we'll make that income. So how much? The net amount deduction which you have claimed earlier minus the deemed deduction, right? This was 3580. Now 35D family. So we understand if the assessee has incurred expenses related to preliminary expenses, then only deduction which is allowed is 1/5. It is not allowed 100% in the very year. In that year, we allow this deduction in 5 equal installment, 1/5, 1/5, 1/5. So generally, examiner will give you, they will not give you this section separately. They will just give you as a one particular adjustment. So let's say in your P&L account, if you find that there is a P&L account and if there is any preliminary expenses of rupees 1 lakh, so what you will do? Only 1/5 you will allow. Only 1/5. 20,000 you will allow. 4/5, that is 80,000. Please disallow it because only 1/5 will be allowed, right? Okay. Second point is that if the question is giving you the cost of the project also, generally they don't give, but if they will give you the cost of the project also, then how much is the preliminary expenses would be allowed? Actual preliminary expenses which the assessee has incurred, or 5% of the cost of the project. 5% of the cost of the project, whichever is lower. This amount will be allowed in 5 equal installments. So first calculate whichever is lower, and then you have to give the deduction in 5 equal installment of this lower amount, right? But if the assessee is a company assessee, if the assessee is a company assessee, in that case, first of all, compare 5% of the cost of the project with 5% of capital employed. So 5% of cost of project and 5% of capital employed should be compared first. Whichever is higher, then this highest that the more amount which is there, you have to compare this with the actual expenses. So whichever is lower, that would be the eligible expenses, and that should be allowed in 5 installment. That is 35D. And we have similar section for VRS. If assessee has incurred for expenses related to VRS, that is also allowed under section 35 double D DDA over here. VRS expenses allowed in 5 equal installments. Double D is not in your syllabus. Amalgamation expenses is not in CA Inter syllabus. Otherwise, these amalgamation expenses are also allowed in 5 equal installments, but this is not there. I have already written. This is for CMAs and CS students. Okay. Come to section 36. It's an important section, 36(1), other deduction. This section says it has a certain list of sections, certain list of expenses which are allowed in the section 36. So if the assessee is paying insurance premium of stock, livestock, then section 36 deduction would be available. Health insurance premium of employees and their family members are also allowed under section 36. But please remember that health insurance premium should not be paid in cash. It should be paid by any other mode, right? Bonus and commission. Salary is not there. Salary would be in 37, but bonus and commission is allowed under section 36, subject to 43B. That is, it should be paid up to the due date of ROI. If it is not paid, then we are not going to allow it. But yes, whenever it will be paid after that, we'll be allowing in that particular year. So please understand bonus and commission. Interest on borrowings. So if you have taken any bank loan, if you have taken any, if you have issued, there is a company, they have issued any debentures or bonds, if they are paying interest, so that interest is also allowed under section 36. But please remember that if you have taken a loan from bank or financial institutions, then in that case, it is allowed under section 36, but subject to 43B also, right? And also remember one more thing, that if you have taken a loan for purchase of any asset, you're purchasing any asset and you have taken a loan, till the date this asset is not put to use, up to that particular date, that interest is not allowed under section 36. Why? Because on that interest, you will be capitalizing that interest. On that interest, you can claim depreciation. It will be forming part of your asset. In that case, the value of the asset, whatever it is, please add that particular value. Once the asset is put to use, after that date, you can claim section 36. Got it? Zero coupon bonds. What are zero coupon bonds? Generally, we don't pay interest on zero coupon bonds, but they are issued at a very subsidized value, less than the face value. So let's say the face value of the bond is 100 rupees and we are issuing it to the public for 30 rupees. So the issue price is 30, and after some years, we will be redeeming at the face value 100. So although we will not pay interest during this particular period, that is the reason they are called zero coupon bonds. But actually, the person who has issued these bonds, right, they are incurring expenses. How much? 70 rupees is the expenses. So 70 rupees expenses which the assessee is incurring, it will be spread over the life of the bond. It will be spread over the life of the bond. So whatever the portion which is falling in our previous year, we will be giving that deduction proportionately. Employer contribution to statutory provident fund, recognized provident fund, pension scheme, these are allowed. This is employer contribution. We are calculating PGBP income. So person who is paying salary, that person is also paying employer contribution, that we call employer contribution to recognized provident fund, approved provident fund, statutory provident fund, that is allowed. But if it is unapproved fund, then it will not be allowed. So first of all, please remember, it should be statutory provident fund or recognized provident fund, or even for pension scheme also. And this would be allowed, please remember, if the employer has actually deposited the amount in that recognized fund, then only it will be allowed. If the employer has not deposited this amount up to the due date of ROI, so here again section 43B will play a role over here. So if the employer has actually deposited the amount up to the due date of ROI, then this deduction is available. If the employer has not deposited this amount up to the due date of ROI, this deduction would not be available. Second important point, please remember, if it is a case of pension scheme, then employer contribution is allowed if it is deposited up to the due date of ROI. But the important point over here is, here this pension scheme amount should not be more than 10% of the salary of the employees. So here in salary, we have to take basic salary plus DA forming part, right? So it should not be more than 10%. So this is again an important point. Okay, bad debts are allowed. So if there is any bad debts, you have actually written it off. You have actually written off your debtors. This is called actual bad debts. Bad debts are allowed. But if it is provision for doubtful debts or any type of provision, that would not be allowed. It should be actual bad debts, which you actually write it off, right? So those bad debts are allowed. Provision for doubtful debts are not allowed. So although provision for doubtful debts are allowed for financial institution, banking companies, but that is not in our syllabus. So that is not, although I have mentioned it over here, but I have also mentioned that this is not for CA students, this is for CMA and CA students. So you don't have to, CA students, you don't have to do it. CMA students, you can do this. Okay. Family planning expenses. First of all, understand these family planning expenses are only and only allowed to company assessee. If the assessee is company, then you can allow these expenses. But if the assessee is non-corporate assessee, for individual HUF, no, please do not allow any family expenses. So here, examiner might confuse you. Let's say this is a P&L account of an individual and they will say family planning expenses. So students will say, oh yes, we have done family planning expenses in section 36, it should be allowed. Please also remember that for individual and any other assessee, it is not allowed. It is only and only allowed for company assessee. And you are not going to allow it for individual or any other assessee. It is only for company assessee. Second thing, if it is a company assessee and they have incurred family planning expenses related to revenue expenses, 100% allowed in that year. If it is capital expenses, it will be allowed 1/5 in 5 equal installment. But please remember, it is only for company assessee. For non-company, family expenses are not allowed. Securities transaction tax or commodities transaction tax, if the assessee is running their business, if they are broker, they are trader of these securities or commodities, in that case only they can claim this deduction, right? So if it is their PGBP income, then they can claim deduction of securities transaction tax or commodities transaction tax. But let's say if the assessee is, let's say I am purchasing shares and then after some time I'm selling these shares. I'm not a trader. I'm not a broker in that case. So my income would be covered under capital gain. In that case also I'll be paying STT, but in that case, in capital gain, while computing capital gain, STT is not allowed. Only while computing PGBP. If it is if this income is in the nature of PGBP, that is for traders or brokers, in that case only you can claim STT deduction. But if you are computing capital gain income, you are selling your shares or other securities, and you are your income is covered under capital gain, in that case it will not be allowed, right? Okay, so this was section 36. Then section 37, specifically it is 37.1, but take it as 37. 37 is general deduction. I tell you that practically more than 90% expenses are allowed under this section 37. So it will not give you, it's a general deduction. It will not give you any list of expenses, but it will give you certain conditions. If those conditions are satisfied, then those expenses are covered under section 37. So generally, your purchases, your sale, your salary if you are paying, your wages you are paying, your freight inward, etc., freight outward, advertisement, such type of expenses are covered under this section 37. Because if these conditions are satisfied, what are these conditions? You should know these conditions. First of all, any expense, if it is covered under section 30 to 36, then can it be allowed under 37? The answer is no, because if there is any specific section which has been made for that particular expense, so it should be covered under that section. So if you would like to claim that particular section in this section 37, if that particular expense in this section 30, then it will only be allowed. First of all, we'll check if there is any specific section, then it should be allowed in that section, not in this section. So first is, it should not be covered under section 30 to 36. Second is that such expense should be revenue in nature. If that expense is capital in nature, no, sorry, we are not going to allow it. It should be revenue in nature. Second thing is, it should not be a personal expense. It should be the expense which is related to your business or profession. And last point is that it should not be illegal. It should not be prohibited by law. If all these four conditions are satisfied, then we are going to allow that particular expense under section 37. And most of the expenses are allowed under section 37. And also remember CSR expenses. CSR is corporate social responsibility. Although Companies Act has already specified that for some certain companies, they have to incur CSR expenses. But income tax says, see, if you are incurring CSR expenses, good enough, good as per Companies Act. But Income Tax Act will say, no, it is not related to your business or profession, so we are not going to allow it. So please, while computing your PGBP income, CSR expenses are not allowed. Okay. And this is one of the examiner's favorite. So if you have incurred any, let's say if you have given any advertisement in any political party brochures or pamphlets or catalog, in that case, that expense is not allowed. So if you give any contribution to political party, that cannot be claimed as a business expense. But yes, we understand we have another section in deduction chapter 80 GGB and 80 GGC. In that case, it can be claimed as a deduction of chapter 6A, but not as a business expense. So if there is any business expense, if the assessee has shown it as a business expense, no, please disallow that expense. 38 I have already covered. 38 is a simple expense. It is a simple section. It says that if any expense, if any type of expense is incurred for business purpose also, profession purpose also, and for other purposes also, for personal purpose also, then only the expense which is related to your business or profession, then that portion will be going to allow it. If it is related to, partly it is related to your personal purpose, we are not going to allow it, right? Simple proportionate deduction. Then we have section 40 small a. It's a very important section, 40 small a. It says, first of all, it has some points in it. 40 small a says that if you are making any payment which is outside India or to a non-resident, if you are paying any payment which is outside India or to a non-resident, and if TDS implications are there, you should deduct TDS. If you should deduct TDS, TDS must be deducted during the previous year. That is up to 31st March 2024 in our case. So TDS must be deducted during the previous year, and it should be deposited up to the due date of ROI. So two things you have to see. First of all, and both the things should be satisfied. It should be deducted during the previous year, deposited up to the due date of ROI. We are going to allow it. We are going to allow it if both these conditions are satisfied. But if any of the condition is not satisfied, then 100% of that expense would be disallowed. If it is paid to outside, if it is paid to non-resident or outside India, we are not going to allow it. 100% will be disallowed. But yes, whenever this amount will be deposited, whenever this TDS will be deposited, in that case, in that year, we are going to allow that expense, right? But please remember, if it is a case of salary, if you are paying salary outside India or to a non-resident, this is salary, right? So if you are paying salary outside India or to a non-resident without TDS, either TDS is not deducted or not deposited up to the due date of ROI, then it will not be allowed. 100% you will be going to disallow it. And if you are paying TDS late also, after some time you are paying TDS also, in that case, it will not be allowed. Its salary would not be allowed, right? If it is other interest, royalty fees for technical service, it can be allowed. But if it is salary, it will not be allowed, right? Second point is that if you are making any payment to a resident within India, you are paying to any resident within India, and on that payment, TDS provisions are applicable. And if you have not followed these two conditions, first condition is TDS not deducted during the previous year. Second is it is not deposited up to the due date of ROI. In that case, if both the conditions are not satisfied, then we are going to disallow 30%. For resident, it is 30%. But if it is for non-resident or outside India, it is 100%, right? So we are going to disallow 30% of it. And yes, whenever you will be depositing the TDS afterwards, then in that case, the 30% amount which we have disallowed, we will be allowing in that year, right? And there is one more point over here also. let's say if the deductor fails to deduct TDS or deposit TDS, in that case, if the deductor fails to deduct, so we'll say we're going to disallow it, and we're going to allow it whenever this TDS is deposited. But let's say the person who is receiving this amount, the person who is the receiver, let's say that person furnishes their ROI and they genuinely pays their tax also. They show this income in their ROI, they genuinely pay the tax also. So we will assume that the TDS has been deposited by the deductor. We will assume that the TDS has been deposited by the deductor and we will be allowing in that year. Correct? This is written over here. What else is mentioned in section 40 small a? See, if there is any expense, let's say in let's say this is the case of individual. In individual P&L account, that person is showing income tax paid or provision for income tax. No, 40 small a specifically says income tax, provision for income tax, interest on income tax. We are not going to allow it, right? We are not going to allow it with the amount which you are paying to the income tax department. Second is tax on non-monetary perquisite. Remember this point. So if there is an employer and this person is providing some non-monetary perquisites like rent-free accommodation, concessional rent accommodation, motor car facility to the employee, and on employee's behalf, this employer is depositing tax on non-monetary perquisite. So this is an expense for the employer, but section 40 small a says, no, we are not going to allow this expense. Right? This was 40 small a very important section. Okay, 40 small b. 40 small b is remuneration to partners. So understand this 40 small b, it's a very easy section. So this section is basically for partnership firms. So if you are paying remuneration to partners, can you pay any amount? No, there is a limit on that. So first of all, you have to make two groups of it. So first is interest on capital. So if it is interest, make it one group, and second group would be your other remuneration. Other remuneration could be a salary to partners, bonus to partners, commission to partners, right? So first of all, talk about interest on capital. So interest on capital can be paid to all the partners, whether these partners are working partners or these partners are non-working partners. You can pay the interest on capital, right? How much you can pay as per the partnership deed. Whatever the partnership deed says, you can pay that particular interest. But if the partnership deed says more than 12% per annum simple interest, no, maximum is 12% per annum simple interest. So interest can be paid to all the partners, working as well as non-working, as per the partnership deed, but not more than 12%, right? Other remuneration can, like salary to partners, bonus to partners, commission to partners. This is other remuneration. Other remuneration can be paid only to working partners. So if you are paying non-working partner, we are not going to allow it. So partnership firm, we are not going to allow it. If you are paying to non-working partners, it should be only to working partners, right? Who are active partners. Is there any limit on that? Yes, there is a limit on that. So first of all, you have to calculate the book profits. So once you calculate the book profits, how these book profits will be calculated, let's revise it. Okay, first of all, understand these limitations. There's whatever the amount which we can pay. So how much amount we can pay? So whatever is the book profits, I'll discuss that book profit also. So first of all, compute your book profits. Let's say your book profits comes to rupees 7 lakhs. So your book profit, let's say, comes to rupees 7 lakh. So you have to make two portions of it. First 3 lakh and the remaining amount. So remaining amount would be 4 lakh. So for first 3 lakh of the book profits, you can pay rupees 1,50,000. This you should remember, 1,50,000 or 90% of such amount, whichever is higher. 1,50,000 or 90% of such amount, whichever is higher. And on the remaining amount, you can pay 60% of the remaining amount. So let's say, for example, your book profit is 7 lakh. For up to 3 lakh, you can pay 150 or 90% of such 3 lakh, whichever is higher. And for the remaining amount, for 4 lakh rupees into 60%, this is the maximum amount which you can pay to the working partners only, right? This you can pay to the working partners only. Now the question is how you will calculate the book profit. It is very easy how you will be calculating the book profits. First of all, calculate your normal PGBP income. Before allowing any remuneration, any interest to partners, just calculate your normal PGBP. Apply all the provisions of PGBP from section 30 to 37, apply all these deductions and all, and compute normally PGBP as per the normal provisions. But do not give any deduction when if you have paid any remuneration, even interest if you have paid to the partners, do not give that effect. Only before that you have to compute your PGBP income. So first step should be determine PGBP income without any interest or remuneration to partners. First of all, first step should be this. Second thing is that whatever is the interest which is allowed to partners, then deduct that. Whatever is the interest allowed to partners, deduct that. And if there is any, this is also an important point. If there is any unabsorbed depreciation of last year. And I'm not saying unabsorbed I'm not saying brought forward losses. I'm saying unabsorbed depreciation of last year. Please give the effect of that unabsorbed depreciation also, right? So after that, if you will deduct these two amounts, you will get your book profit. This is how book profits are computed, and the maximum remuneration you can pay, whatever is your book profit on first 3 lakh, this much amount, on remaining amount, 60% of such book profits, right? And finally, how you will be calculating the PGBP income of the firm? So whatever is the book profits, just deduct the remuneration which you are paying to the partners, which is allowed. Deduct that, you will get your PGBP income also. Right? So this was section 40 small b. Then we have another important sections. 40 small b is a bit important also. 40A2, 40A3, very important sections. And you all understand that this PGBP is important, and these all these sections which are on or after these series of 40, all these sections are important for examination. Section 48.2, that is, if you are making any payment to the related party, if you are making any payment to the related party and which is in excess of fair market value. Let's say the fair market value is 15,000 and you are paying 18,000. The actual payment you are making 18,000, which is 3,000 extra. So this 3,000 excess amount, this excess amount will not be allowed. So first of all, remember that who is the related party. So for if the assessee is individual, then individual relative is the related party. Relative here means it could be the spouse of the individual, sibling means brother or sister of the individual, or their parents, grandparents, children, grandchildren. That is linear ascendant or linear descendant. So for relative, these are the related party. If the assessee is partnership firm, HUF company, then who are the related party? So for partnership firm, partners are related and their relatives. Partners, let's say partner, any of the partner is a related person, and partners relatives, let's say partners spouse, partner sibling like brother and sister, they are also related. For HUF AUP, again members and their relatives. Company, directors are the relatives. Directors and their relatives are the related party, right? So director's wife, director's brother, they are all related party. Okay. Shareholder can be related person. The answer could be yes, but that shareholder should at least hold 20% or more. That person should have a substantial interest. So for other person, let's say for director, for company, director is the related person. So shareholder can be the related person, yes, if that person is having a substantial ownership. Substantial ownership here means 20% or more ownership, right? In that case, that person is also related party. But please remember, in excess of fair market value. So whatever is that excess, that extra amount which you are paying, that will not be allowed as per section 40A2. 40A3, a very, very important section. If you are making a cash payment, whenever I'll say cash payment, cash also include bearer check and cross check. I'm not saying account pay check. So cash, bearer check, cross check, same category. They are as good as cash. So amount should be paid by account pay check, account pay bank draft, NEFT, RTGS, any type of electronic payment, banking mode payment, UPI wallet through. If you are making the payment through these modes, then it is allowed. If you are making a payment through cash, bearer check, cross check, it is not allowed, right? How much we can pay through cash, bearer check, cross check? Maximum 10,000 rupees in a single day to a single party, right? The maximum 10,000 rupees in a single day to a single party we can pay. But yes, if it is transporter, you can pay the payment up to 35,000 rupees in a single day. Also for transporter, 35,000 you can pay. For others, only 10,000 you can pay. More than 10,000 will not be allowed. Okay, let's say if you have paid, let's say 40,000 rupees, then whether the excess of 10,000 rupees, 30,000 will be disallowed, or entire 40,000 will be disallowed. Entire 40,000 will be disallowed, right? If you have paid the payment of 11,000 rupees, entire 11,000 will be disallowed, correct? Okay. But yes, there are certain exceptions also. If you are making a payment, if you are making the payment to bank, to government, you can pay in excess of 10,000 also, correct? So these are the exceptions. These exceptions are bit important. Second is that if you are making a payment for purchasing agriculture produce, and to whom you are making the payment, you are making the payment to that person who is actually the cultivator, the producer, the grower of that agriculture produce. If you are making a payment to that person, in that case, if you are making a payment of more than 10,000 also, then it is allowed. And also, if you are making a payment to the person who is a manufacturer of certain products, these are handicraft products, these are made without the aid of power, without the electricity, without the use of electricity. So if you are making a payment to that person who is actually the manufacturer, who is the first manufacturer of these things, then you can make the payment of more than 10,000 also, right? And if you are making a payment in any village or any such place where that person, where he resides or where he is into business, that person is not having any banking services, in that case also you can make the payment. correct? And if the employee is getting retired, then you can make a payment up to 50,000 rupees. And if you are making a payment for authorized dealer for purchase of foreign currency, then also you can make the payment in cash, right? So these are certain important points you should know. 40A7 says that if you are actually depositing into approved gratuity fund, then only it is allowed. So if it is not approved gratuity fund, it will not be allowed. Let's say examiner will confuse you. They will say that this gratuity fund is actually as per the actuarial valuation. So please don't allow it. It should be a approved gratuity fund. Then only you can allow it. If it is an unapproved fund, please don't allow it, right? Section 41 is deemed business income. I have discussed some of the points before also. Let's say if you are selling your power generating asset, or you are selling your scientific research asset, then whatever is the income which is more than the WDV, that becomes your income taxable under PGBP under section 41. 41 covers also some other points. Let's say there is any bad debts. There in the past, there is any bad debts which have been claimed by the assessee. And if those bad debts are now getting recovered, so in case of recovery of bad debts, then that in the year of recovery, it will become your business income. It will become your DNPGBP income. Or also if there is any cessation of trading liability, let's say you have to pay to someone, there were certain creditors, and whenever you have purchased this particular goods from them, it was a credit purchase and you have claimed it as an expense. So you have already claimed it as an expense in any earlier year. Now you are not paying to this creditor and you have written off his account. In that case also, that is called cessation of trading liability, that it will become your PGBP income in the year when you are writing off the account of that creditor. Okay. Section 43B, a very important section, in fact a very important section, and there is a small amendment also in this section which makes this section more important. 43B has a list of certain expenses, and these expenses are allowed only when actual payment is made up to the due date of ROI. So you should make the payment during the previous year, or even up to the due date of ROI, we are going to allow it. If these expenses are not paid up to the due date of ROI, we are not going to allow it. Yes, if they are paid after the due date, in this year we are not going to allow it, but whenever they will be paid subsequently after 1 year, 2 years, 3 years, we'll be allowing it in that particular year. Correct. So what is the list? What are those expenses which are covered under section 43B? So first of all, understand any type of tax or cess. Let's say it's a municipal tax of building, or even it is a case of GST. Let's say you have not paid the GST up to the due date, it will not be allowed. But if you have paid GST, custom duty, etc., it will be allowed. What about income tax? Income tax will never be allowed, right? 40 small a is already discussed that income tax will not be allowed. So other than income tax, if it is any type of tax or cess payable to government, it is allowed, but it should be actually paid to the government up to the due date of ROI. Bonus or commission, I have already discussed. If you are paying bonus and commission to the employee, it is allowed under section 36. But 43B also says that it should be paid up to the due date of ROI. Otherwise, we are not going to allow it. Interest to any bank, financial institutions, and notified NBFCs, you should pay up to the due date of ROI. Right? If you are not paid up to the due date of ROI, we are not going to allow that particular interest, which is payable to bank, financial institutions, or notified NBFCs. Leave salary. If you are paying this leave salary to the employee, it should be paid up to the due date of ROI. Otherwise, we are not going to allow it. And if you have to pay any amount because you are using railways asset, Indian Railway asset, and you have to pay any amount to the Indian Railways, it will be allowed, but provided you should have paid this amount up to the due date of ROI. If you have paid, okay, we're going to allow it. Not paid, disallow this year. And when it will be allowed, whenever it will be paid, in that year it will be allowed in that case. This is an amendment over here, MSME. If you are making a payment to MSME, let's say if you are making any payment, if you have purchased anything, you have entered into any transaction with MSME, and now you have to pay the amount. So whether it is allowed on accrual basis or payment basis. So this section says, this particular point says that first of all, please understand whether please determine whether there is a written agreement between you and MSME or there is no written agreement. So whether there is a written agreement or no written agreement. If there is a written agreement, so if you pay as per the written agreement, then allowed on accrual basis. But if you pay after that particular, let's say that written agreement is, in that written agreement, it is mentioned that you have to pay within 35 days. Let's say if you pay as per the written agreement, accrual basis, but if you pay after this particular days, it would be on actual payment basis only, right? But yes, here is a point over here. if you are paying as per the written agreement, you should pay as per the written agreement, but that days, number of days should not be more than 45 days. So if the written agreement says 50 days, you can make the payment within 15 days. So we'll cut 50, we'll take maximum 45 days, right? If written agreement says less, we can take less, but it should not be more than 45 days, correct? So if you are making the payment after 45 days, we are not going to allow it on accrual basis. We will be going to allow it only on payment basis, correct? Here we please remember, in all these particular expenses, you have to see the due date of ROI. You have to see the due date of ROI. But in case of MSME, you don't have to see the due date of ROI. It has its own date, right? It has its own date. So if there is a written agreement, as per the written agreement, but it should not be more than 45, right? If you are making a payment after 45 days, then in that case, it would be as per the payment basis, not as per accrual basis. Second thing is that if there is no written agreement, please make the payment within 15 days. It will be allowed on accrual basis. But if the payment is not made within 15 days, it is made after 15 days, then only on payment basis it will be allowed. So this is an important amendment. Examiner can ask you MCQ on this particular point, or it can give you as a point in your descriptive question also. Section 43 CA, real estate business. Actually, this section is very much similar to one of the section of capital gain, that is section 50C. It's a very important section 50C in capital gain, and the same provision is there in 43C also. And both these sections are applicable if you are selling immovable property like land or building or both. If you are selling this immovable property real estate transaction, then this section is applicable. If you are into business of selling this immovable property, then 43 CA would be applicable because you will be getting PGBP income. If you are not into business, if you are selling your own land or own building, then 50C would be applicable because that would be depends how you are holding it. If you are holding it as a stock in trade, 43 CA will be applicable. If you are holding it as a capital asset, then capital gain sections would be applicable in that case. Okay, what it is, it says that whenever you sell these land, building or both, we will also see their stamp duty value. So if stamp duty value is more than 110% of your actual selling price, whatever the actual consideration which you are saying that I have sold this particular land, I have sold this particular building, we will take 110% of that amount. So, and we will compare this 110% with the SDV. SDV is stamp duty value. And if we find that SDV is more than this 110%, then 10% is the grace we are giving. So if this SDV is more than 10% of the value, please write it over here. SDV is greater than 110% of actual consideration, then only these section will come into play. Then only these sections will be attracted. Otherwise, whatever is your selling price, if it is not more than this amount, then whatever is your selling price, you will take that as a selling price, right? But if SDV is more, then 43 CA will come into picture in PGBP, and similarly in capital gain 50C will come into picture. Got it? So we have to compare whether this SDV is more than 110% of the actual consideration. If it is more, then we will not take your actual consideration, we will take your SDV. Sale consideration should not be less than the stamp duty value. Actual sale price admissible if stamp duty value does not exceed 110% of the selling price. Same thing which I was just mentioning, right? So in case if SDV is more than 110%, this SDV will become your deemed selling price. It will become your deemed selling price. Got it? And which date SDV you should take? Generally, the date on which we are transferring this immovable property, we will take that SDV value, right? But if the assessee claims that, sir, there is a prior date agreement, then assessee has to prove that something has been received, the consideration or even the part of the consideration should be received by any mode other than cash, right? It should be a banking transaction mode. It should be account pay check, account pay bank draft, the same banking mode. So if you prove that there is a prior date agreement and something was received on that date of agreement by any mode other than cash, bearer check or cross check, that is through banking mode, then we will take the SDV of the agreement date. Correct? This was again important. Same provision is there in 43CA also and in section 50C also of capital gain. Okay, again these sections, this page is very important. 44AA, 44AB. 44AA is maintenance of books of accounts, 44AB is tax audit. So first discuss 44AA, who is required to maintain books of accounts. Again, an important section for examination purpose. So first of all, here again you have to make two groups. You have to make two groups for 44AA. First group is of notified professionals. Not all professionals, I am saying notified professionals. So there are certain notified professionals like chartered accountant, cost accountant, company secretaries, doctors, engineers, architects, film stars, etc. So medical professional, engineer, lawyers, CA, CMA, CS, architects, interior designers, film artists, these are notified professionals. So one group will make of notified professionals. Other group is the remaining one. Remaining here would be all businesses would be in other group, and also other professionals who are not notified, they will be coming in second group. So first we'll talk with the first group. The first group who are notified professional, we will say you have to always maintain the books of accounts. You have to always maintain the books of accounts, right? And if your last 3 year turnover, last 3 years preceding to the previous year, your last three years turnover, that is gross assets, is more than 1.5 lakh for all 3 years. All 3 years, it should be for all 3 years. If the gross assets of all 3 years, gross assets means turnover, right? So if their gross assets of last 3 years, all 3 years should be tick. If it is more than 1.5 lakh, then you have to maintain prescribed books of accounts. Otherwise, you have to maintain minimum books of accounts. But if your last 3 years gross assets, all 3 years is more than 1.5 lakh, then you have to maintain prescribed books of accounts. What are these prescribed books of accounts? Cash book, general ledger are prescribed books of accounts, and also the bills issued by you. The bills issued by you, you must be having the duplicate copy, right? So you should keep that duplicate copy if the bill issued by you is more than 25 rupees. And if you have received certain bills, you must be having the original copy of the bills received. And if it is more than 50 rupees, you should keep that bill receipt also, that original invoice also, right? And you should maintain these particular documents for at least 6 years, And also, in case if the person is into medical professional, that is doctor, then they have to maintain their daily case register, patients register, and also if they are holding inventory medicines, then they have to keep the record of that inventory details also. So this is for notified professionals. Now our second group contains other businesses, all businesses and other professions, right? So for them, it is not actually required to maintain the books of accounts if their income is very low or their turnover is low. In that case, they are not supposed to maintain their books of accounts. But either if their income is more than the prescribed limit, either the income is more or the turnover is more, either of the two, right? Income criteria, first we will see the income criteria. If the income criteria is satisfied, we will say maintain books of accounts. If the income criteria is not satisfied, we will also see the turnover criteria. So any of the criteria, whether income or turnover, if any of the criteria get satisfied, we will say that you have to maintain the books of accounts also, right? Now, how much is the income criteria and how much is the turnover criteria? For that, first of all, we have to split them, that who are individual or HUF. For individual and HUF, so all businesses and other professionals, we will see whether they are individual SSE or HUF SSE or other SSE. For individual, it is important. So for individual, the income criteria is 2.5 lakh. If it is your income exceeds 2.5 lakh of any of the last 3 years, of any, here I am saying any. In that case, for notified professional, I have used the word all 3 years. Here I am using any 3 years. So if any of the last 3 years preceding the previous year, any of those income is more than 2.5 lakh. If any answer, let's say last 3 years are first, second and third year. And let's say in third year, we have more than 2.5 lakh. In second year, we don't. In first year, we don't. But still, any of the 3 year has income of more than 2.5 lakh. We will say that you have to maintain the books of accounts in this year, right? Let's say if any of those years, the income is not more than 2.5 lakh, the income criteria is not satisfied, then apply turnover criteria. If the turnover is more than 25 lakh, if the turnover is more than 25 lakh of any of the year, then we will say you have to maintain the books of accounts, right? But if these SSE are not individual HUF, in that case, the income criteria would be 1.2 lakh, turnover criteria would be 10 lakh. Got it? So generally, individual and HUF is important, 2.5 and 25, but for others, it is 1.2 and 10 lakh, right? And let's say if they are unable to tell their last 3 years information. Why? Because it's a new business or a new profession. In that case, we will ask them if your income is likely to exceed this limit or your turnover is likely to exceed these limits. The limits are same, right? So if your income is likely to exceed 2.5 lakh or your turnover is likely to exceed 25 lakh, then you have to maintain books of account. Or in this case, if they are not individual HUF, your income is likely to exceed 1.2 lakh, turnover more than 10 lakh, then you have to maintain books of accounts, right? And yes, we will be discussing those people who can claim deduction, who can claim their income on the on presumptive basis. Those people are not required to maintain books of accounts. That I'll be discussing. Those people are not required to maintain books of accounts also, and they are not required to get their tax audit done also. So we'll discuss about these also. 44 AD, 44 ADA, 44 AE. They are not required to maintain books of accounts, neither for tax audit. Let me first discuss about 44 AB tax audit. Important. This is an important section, 44 AD, AB. First of all, again, we will make two groups. But now the groups are a bit simple. Right? Here we will keep professionals in one group, all professionals, notified professionals, no, all professions in one group, and businesses in another group. So here the criteria of segregating, making these groups are very simple. Professionals, one, businesses, other, right? So first of all, talk about professionals. I'm talking about professionals. So if the assessee is getting profession and his gross receipts during the previous year, last year's, no, during the previous year, because audit will be done after the previous year, right? So if in the previous year, the turnover of these professionals is more than 50 lakh, then they are required to get their accounts audited. They are required to get their accounts audited as per section 44 AB. So for them, the criteria is 50 lakh rupees. For businesses, we will see. So here we have to see, generally the criteria is 1 crore for businesses if it is the turnover of the previous year. We are doing previous year 23-24, right? So for businesses, if the turnover of the previous year is more than 1 crore, they are required to get their accounts audited. But here it is important, something which is important. I would like your consideration over here. If their cash transactions are very less, they are most of the transaction which they do, most of the payments they make, most of the receipts they take is mostly through banking channel. It is not in the form of cash. In that case, their turnover will be seen as 10 crores. Will not apply 1 crore in that case. We will see 10 crore in that case. So I'm again repeating. For professionals, 50 lakhs straight. For businesses, generally 1 crore. But if their transactions are basically payments and receipts are basically mostly through banking channels. So say if it is through banking channel, so they are running a transparent business. So in that case, we rely on them. So we have given them criteria of 10 crore rupees in that case. So how much should be the cash receipts or cash payment? 5%. So if your cash receipts of the total receipts, your cash receipts is 5% of your total payments, the cash payments is just not more than 5%. In that case, you are running a transparent business. In that case, 10 crore we are going to apply in that case, right? In that case, it would be 10 crore. So business assessee with cash transaction, cash receipts and cash payment both should be up to 5%, then 10 crore, otherwise 1 crore, right? So what is 2 crore over there? That is 4480 that I'll be discussing. Okay. Now come to another sections. These again three important section: 44 AD, 44 AD, and 44 AE. These section 44B, 44 BBA is not for CA intermediate student. This is for CMA students and CA students, right? So I'll be discussing these three sections with you. 44 AD, presumptive income. First of all, please understand these presumptive income is this section 44 AD is only and only available to resident assessee, not for non-resident. It is for resident. Second thing is, if the assessee is resident individual, resident HUF, resident partnership firm, full stop. Resident individual, resident HUF, resident partnership firm, and not even LLP. That firm should be a normal firm, not LLP. Then 44 AD, they can claim their income on presumptive basis. Right? Other criteria I'll be discussing just now, but this section is very important, especially for your May 24 examination. Why? There is a important amendment over here. So here, this 44A, see, these presumptive income scheme is mainly for those assessee who are not running a very large businesses or profession. This is for small businesses, right? So generally the criteria was if your turnover is not more than 2 crore. If your turnover, resident individual, resident HUF, resident partnership firm other than LLP. If your turnover is not more than 2 crore, you can come in this, you can opt this 4480 presumptive income, right? But here there is an amendment now. There is an amendment now. Now there is a one more limit of 3 crores. There is one more limit of 3 crores now. For whom 2 crore is still there, but now there is one more limit of 3 crore for those people whose cash transaction, whose cash receipts here, because 4480 is mainly based on turnover, right? So here we will see cash receipts. Whose cash receipts are very nominal, are very minimal. How much? Not more than 5%. So if your cash receipts during the year is not more than 5% of the total receipts which you have earned, it's not more than 5%, then we will be giving you 3 crore limit, right? So generally it is 2 crore for all the people. It is still today also, it is 2 crore for all the people also. For the, I'm not saying that 2 crore limit is being increased to 3 crore. No, 2 crore is still there. One more limit is added over here of rupees 3 crores, right? So if your cash transaction is not more than, your cash receipts is not more than 5%, it is up to 5%, then the limit would be 3 crore in that case. So let's say examiner will ask you that there is an individual, resident individual, whose turnover is 260 lakh, whose turnover is 260 lakh. Tell me whether this person can claim 4480 or not. The answer could be yes also. Why? If it is 260 lakh, then it is 2.6 crore, right? So first we will see how much is the cash receipts. How much is the, out of this 260 lakh, how much is the cash receipts? Let's say the cash receipts is, let's say 3 lakh rupees. So if you will compute the percentage, 3 lakh divided by 260 lakh, you will get not more than 5% in that case. So in that case, yes, this person can come, because here we will apply the 3 crore limit over here. Okay. Now understand how much. Now this person is having 3 lakh as the cash receipts and 257 lakh as banking receipts. So in this case, how much presumptive income it would be? Will be applying a percentage for cash receipts. The cash receipts, it would be 8%, and for banking receipts will be applying 6% over here. So it is the minimum percentage. If the assessee want, that person can apply in spite of 8%, that person can apply 9%, 10%, 11%, because in that case he will be paying extra tax. If that person is ready to pay extra tax, that is okay with us. But if that person says no, I'll be claiming less than 8%, I'll be claiming 5%, 4%, no, in that case 4480 will not be applicable in that case. And also in that case, that person is required to prove this by maintaining books of accounts, and also would like to get the audit done also in that case. So if the presumptive income, how much would be the presumptive income? Minimum 8%. Minimum 8%, should not be less than 8%. But yes, in case of banking transaction, it is 6% in that case. Important point. This section 4480 would not be applicable to notified professionals. The notified professional, that medical professional, engineer, chartered accountant, cost accountant, company secretary, film artist, it is not applicable to them. Why is it not applicable to them? For them, we have a special section 4480, right? Second point is that if the assessee is into banking business, if the assessee is into, if the assessee into brokerage business, of that assessee is getting commission or brokerage, or into agency business, that case also this section would not be applicable for that. And if the person is carrying goods carriage vehicle business, 44A is there, so that person cannot come in 44AD, that person will go in 44AE. A person claiming deduction under section 10AA or profit link deduction of chapter 6, a profit link deduction from 80 IA series to 80 RRB. So if the person is claiming deduction under section 10AA or chapter 6, say profit link deduction, that person can also not come under section 4480. So who can come? Only resident individual, resident HUF, resident partnership firm other than LLP, and their turnover should not more than 2 crore or 3 crore as the case may be. How much would be the income? 6% or 8%. That is the minimum amount. If you want, you can show extra income, more income, more than 6% or more than 8%, but not less than that. Okay. Next section is 44ADA. It is again important because there is a little amendment also over here. 44ADA is for presumptive income for notified professional, for chartered accountant, cost accountant, company secretary, medical professions. This section will come into play. 44ADA. So your turnover, your gross receipts should not be more than 50 lakh. Your gross receipts should not be more than 50 lakh. But yes, there is an amendment over here. If the gross receipts is up to 75 lakh also, and your majorly transactions, majorly receipts are through banking channels, then we will give you 75 lakh, right? So 75 lakh, if the cash receipts is up to 5%, then 75 lakh, this is the amendment now. But 50 lakh is also there. If the cash transactions are more than 5%, then 50 lakh. And if it is up to 5%, 5% or less, then 75 lakh. So whatever is your turnover is, 50 lakh or 75 lakh as the case may be, whatever your turnover is, so you will show your turnover and the presumptive income would be 50% of your gross. Please remember 50% of your gross. So if a person is running a notified profession and let's say his turnover is 40 lakh, so how much is the presumptive income? 50%. This is the income. This is not tax. This is income. On this income, you will be calculating tax. So 40 lakh into 50%, 20 lakh would be the PGBP income. So on this income, you can calculate tax. So please, some people get confused in this. So this is the tax. No, this is not tax. This is income. These sections are of presumptive income. This is not presumptive tax. This is presumptive income. On this income, we will be calculating tax. Okay. Next deduction, next presumptive income section is section 44A. 44A is available to those people, to those businesses who are engaged in goods transportation. They are into business of flying, hiring or leasing of goods carriage vehicle. So for them, section 44A is applicable. Here we will see that the total number of vehicles, you are the owner of this vehicle, which is the total number of vehicles should not be more than 10 vehicles at any time during the previous year. Let's say if you are a big transporter, then 44A will not be applicable. So if you have vehicles, you have 1 truck, 2 trucks, 3 trucks, up to 10, it's okay. But if it is more than 10 at any time during the previous year, we are not going to give you 44AE presumptive income section, right? It should not be more than 10 at any time during the previous year. Heavy goods vehicle, so how much would be the income? So it depends that the truck is a big truck or a small truck. So how we'll determine as per the gross vehicle weight. So if the vehicle weight of that truck is more than 12 tons, if it is more than 12 tons, it will be considered as a big truck. And if it is up to 12 tons or less than 12 tons, up to 12 or less than 12, in that case, it would be a small truck or a small vehicle. So for a small vehicle, the presumptive income would be 7,500 per month per vehicle, 7,500 per month per vehicle. And if it is part of the month, let's say the assessee is the owner for 7 months and 20 days, we'll take it part of the month as full month. So here we'll take it as 8 months. So 7,500 into 8 months in that case, right? So please remember 7,500 per month for every month or part of the month. We'll take 7,500 for small vehicles. What are small vehicles? Not more than 12 tons in gross vehicle weight of that particular vehicle. And if it is more than 12 tons, let's say there is a truck and the weight of that truck is 16 tons in that case. So how much is the presumptive income? For every ton, 1,000 rupees. For every ton, it is 1,000 rupees. So if it is 16 tons, then 16 tons means 16,000, right? So it would be 16,000 per month per vehicle. And same concept will be applied over here. For part of the month, you have to take full month, correct? So for if it is a small truck, up to 12 tons, 7,500. And if it is more than 12 tons, then for every ton, 1,000. And for the part of the ton also 1,000, right? So if there is a vehicle weight of 16.5 tons, so how much you will take? 17,000. Part of the month, part of that ton would be rounded off to the next multiple. That would be 17,000 in that case. It would be considered as 17 tons. Got it? So these are the sections which are related to deductions. 44B, BBA are not in CA intermediate syllabus. Agriculture incomes. This is again very important topic and you should remember this table. Please remember this table by heart. This is something which is examiner's favorite and they do ask such type of question on these things. So if the assessee is into such kind of business, so part of the business is related to agriculture activities, part of the business is related to industrial or business activities. So we have to segregate how much is the income which is related to exempt, that is agriculture income, and how much is the business income. So they have given us a percentage. I would highly recommend you, please learn these percentages. It's very important. So for rubber business, 35%, whatever is the business income from rubber, 35% will go in business, 65% will go in agriculture. If it is tea business, 40% will go in business, 60% will go in agriculture. And you will see that the higher the percentages, it is going in agriculture, right? So the lower amount which is coming in business, the higher amount is going in agriculture, right? If it is coffee business, so for rubber, I'm repeating 35%, 65%, for tea, it is 40 and 60. If it is coffee business, so if the assessee is only engaged in the activities like growing and curing of coffee, 25% business, 75% agriculture. But if they are doing some more activities like growing, curing, roasted and grounded also, 40% towards business, 60% towards agriculture. A very, very important table, right? So I believe that you are able to revise your PGBP in a very comprehensive way also and super fast manner also. And if you would like me to cover some other particular topic also, particular chapter also, please, I would request you to mention that particular chapter name also in the comment section. Till then, thank you so much. Bye and take care. And you can download this chart book also, available for you on the website. Bye.